The Great Tax Leak: How the Wealthy Legally Avoid Paying the Middle Class Tax. The greatest threat to your generational wealth isn't a market crash, and it isn't inflation. It is the silent, legal, and compounding erosion caused by taxes. If you build a $5 million portfolio, but have to pay 40% in capital gains and income taxes to access it, you don't have $5 million, you have 3. You spent 30 years building a machine, and the government owns 40% of the gears. Most people focus entirely on the accumulation phase, how to grow the pile, but they completely ignore the distribution phase, how to get the money out. They spend decades being tax blind, only to realize at the finish line that they've built their wealth in a cage. Today, we are opening that cage. We are diving into the tax-efficient exits. This is the blueprint used by the top 1% to legally minimize their tax liability, maximize their spendable income, and ensure their wealth transfers to the next generation without being gutted by the state. This is the final pillar of the wealth architect. To understand the exit, you first have to understand the tax hierarchy. Not all income is taxed equally. Yet most people earn 100% of their money in the most heavily taxed category, earned income. This is your salary, your wages, and your bonuses. It is taxed at the highest rates. It is the only form of income where the government takes its cut before you even see the check. This is the employee trap. If you stay in this category, you are fighting an uphill battle. The wealth architect's goal: to transition as much income as possible into capital gains and passive income. Here, the rates are lower, the deductions are higher. The timing of the tax is under your control, not the government's. The first step in the exit blueprint is location optimization. It's not just about what you buy, but where you hold it. Most investors treat their brokerage accounts, their 401ks, and their Roth IRAs like a single bucket. This is a massive mistake. Different assets belong in different tax vehicles. This is what we call asset location. High-growth assets that you plan to hold for decades belong in taxable brokerage accounts or Roth accounts to take advantage of long-term capital gains rates. Inefficient, high-tax assets like REITs or high-turnover funds belong in tax-deferred accounts. By matching the asset to the right bucket, you effectively increase your net return by 1% to 2% every year without taking any extra market risk over 30 years. That 2% difference is the difference between retiring comfortably and retiring wealthy. But the real magic happens when we talk about the 0% capital gains bracket. Most people believe that if you sell a stock for a profit, you must pay tax. That is a lie. In many tax jurisdictions, including the United States, there is a specific income threshold where the long-term capital gains tax rate is exactly 0%. If you structure your exit correctly, you can harvest your gains strategically to stay within this bracket. Effectively, you pull money out of the market completely tax-free. This requires a multi-bucket strategy. You pull a little from your taxable account, a little from your tax-deferred account, and a little from your tax-free Roth. By blending your withdrawals, you can live a six-figure lifestyle while reporting a taxable income that qualifies for the 0% rate. This is how the wealthy stay poor on paper while living rich in reality. Then, we have the most powerful tool in the architect's arsenal, the step-up in basis. This is the ultimate legacy move. When you sell an asset during your lifetime, you pay tax on the growth. But if you hold the asset until you pass away and leave it to your heirs, the cost basis of that asset is stepped up to its current market value. Your children can sell that asset the next day and pay zero, I repeat, zero capital gains tax on decades of growth. the government's claim on that wealth simply vanishes. This is why the 1% never sell their core assets. They borrow against them. They live off the dividends, but they never sell. They understand that death is the ultimate tax shield. But what if you need that money now? This leads us to the buy, borrow, die strategy. This is a controversial but legal framework used by the ultra-wealthy. Instead of selling their shares to fund their lifestyle, which would trigger a massive tax bill, they take out a line of credit against their portfolio. Because a loan is not considered income, it is not taxable. They live off the borrowed money at a low interest rate, while their assets continue to grow at a higher rate. When they pass away, the step up in basis wipes out the tax on the growth. A small portion of the assets is sold tax-free to pay off the loan. The remaining wealth goes to the heirs, untouched by the IRS. This is how you use the banking system to defeat the tax system. For those focused on real estate, the blueprint is even more aggressive. We use the 1031 exchange. This allows an owner to sell a property and reinvest the proceeds into a like-kind property while deferring 100% of the capital gains tax. You can do this indefinitely, selling a small duplex to buy a fourplex, then selling that to buy an apartment complex. You are rolling your tax bill forward for your entire life. You allow your wealth to compound on the government's money. It is an interest-free loan from the Treasury that you never have to pay back as long as you keep moving forward. The great tax leak happens when you are passive. It happens when you follow the standard advice of just contributing to a 401,000 and hoping for the best. The system is designed to reward those who understand the rules and punish those who don't. To be a wealth architect, you must stop being a taxpayer and start being a tax strategist. You must look at every investment through the lens of the net after-tax return. A 10% return that is taxed at 40% is worse than a 7% return that is taxed at 0%. The exit is the final part of the journey. It is the moment you transition from building the fortress to living within it. But you cannot wait until the day you retire to start thinking about this. The moves you make today, which accounts you open, which assets you buy, and how you title your property will determine whether you own your wealth or whether you are just a temporary custodian for the government. In this series, we've covered the owner's mindset, the mathematics of volatility, and now the tax-efficient exit. You now have the 3 pillars of the wealth architect. You have the blueprint to stop trading time for money and start engineering a life of absolute freedom. But a blueprint is just paper until you start the construction. The question isn't whether the system is fair. The question is, are you going to let the system work against you? Or are you going to learn the rules and make the system work for you? The great tax leak is real, but it is preventable. If you're ready to stop losing your wealth to the silent tax, hit the subscribe button. Join us as we move into our next series, The Psychological Edge, the mental frameworks required to stay disciplined when the rest of the world is losing its mind. Your wealth is being sculpted. Make sure you're the one holding the chisel.